A federally chartered American crypto bank just put a Bitcoin-linked income asset on its own balance sheet. Not a trader, not a YouTuber, not a hedge fund gambling with borrowed money at midnight. A regulated bank, operating under federal oversight, decided that exposure tied directly to the Bitcoin ecosystem belongs inside its official financial strategy. That is what happened. And the reason this matters is simple. When institutions with licenses, compliance teams, regulators, and reputations to protect start moving like this, the conversation changes. Bitcoin is no longer sitting outside the system trying to get in. It is moving deeper into the system itself. Most people are going to miss what this signal actually means because they are still watching Bitcoin the old way. They are staring at candles, arguing over pullbacks, waiting for dramatic headlines, acting like the story begins and ends with price. That is not where the real shift is happening. The real shift is happening inside balance sheets, capital structures, custody frameworks, and regulated financial products. The market is still obsessed with noise. Meanwhile, the institutions are building architecture. And once the architecture is in place, the next phase of adoption stops looking speculative and starts looking inevitable. What just happened is not important because of the size of one purchase alone. It is important because of who made it, what they bought, and what that tells you about where regulated finance is quietly heading next. A bank with a federal charter did not just buy random crypto exposure. It bought a structured, yield-producing instrument tied to the biggest corporate Bitcoin balance sheet in the world. That is a very different message from a simple, "We like Bitcoin" headline. That is a message about design, about positioning, about intent. It tells you institutions are not just dipping a toe into digital assets anymore. They are learning how to structure around them. That phrase matters more than most people realize. Institutions do not move like retail investors. Retail reacts. Institutions engineer. Retail chases stories after they explode. Institutions spend months building the rails before the public even notices the train has left the station. So when a regulated bank chooses to hold a Bitcoin-linked preferred instrument, the real story is not the headline itself. The real story is that this move likely came after layers of legal review, risk assessment, internal debate, regulatory sensitivity, and strategic planning. Nothing about it is casual. Nothing about it is impulsive. Which means the people closest to the plumbing of modern finance are getting more comfortable treating Bitcoin-related exposure as a serious balance sheet consideration. To understand why this is such a big deal, you have to understand the institution making the move. This is not just another crypto startup trying to sound important. This is the first crypto-focused company in the United States to receive a federal banking charter. That single fact separates it from almost every other name in the digital asset world. A charter is not branding. A charter is not vibes. A charter is the difference between operating near the financial system and operating inside it. It means scrutiny. It means oversight. It means standards. It means every major strategic move carries a different weight because the consequences of getting it wrong are not theoretical. That is why this purchase lands differently. When a loosely regulated company buys Bitcoin exposure, people can dismiss it as opportunistic. When a federally chartered institution does it, you have to ask a harder question. What are they seeing that the broader market is still underestimating? Because institutions like this do not get rewarded for reckless symbolism. They get rewarded for surviving, compounding, and staying on the right side of regulators while positioning ahead of the crowd. So if they are willing to put a Bitcoin-related security onto the balance sheet, that suggests a level of conviction that goes far beyond a press release. Now let's talk about what they actually bought, because this is where the story gets even more interesting. They did not buy common equity for maximum volatility. They did not just grab spot Bitcoin and call it a day. They bought a preferred instrument tied to the company that has become the most aggressive corporate Bitcoin accumulator in public markets. That matters because preferred securities sit in a different part of the capital stack. They are built for investors who want priority, income, and structure. In other words, this was not simply a directional bet. It was a strategic allocation. The company behind that instrument has already transformed itself into one of the most important Bitcoin vehicles on Earth. What began as a conventional software business turned into something far more radical when its leadership decided that holding cash was the real risk, and Bitcoin was the superior treasury asset. Since then, it has accumulated an enormous Bitcoin position, turning its balance sheet into a kind of corporate Bitcoin engine. The market has argued endlessly about whether that strategy is genius or madness. But one fact is impossible to ignore. It created a new template. And now other institutions are not just watching it, they are starting to build around it. That preferred stock is attractive for a reason. It sits above common shareholders in priority. It is designed to deliver income. And because it is tied to a company whose identity is now deeply linked to Bitcoin, it offers a different type of exposure than simply buying the asset outright. You are not just riding price. You are entering a structured relationship with an entity that has already committed itself to the Bitcoin thesis at a scale almost nobody else has matched. That makes it easier for certain institutions to participate because structure matters, yield matters, seniority matters, predictability matters. And in regulated finance, those things often matter more than raw excitement. This is why the move is so powerful. A federally chartered bank did not merely say Bitcoin is interesting. It said a Bitcoin-linked preferred security can be worthy of balance sheet space. That is a much stronger signal. It suggests that the institutional conversation is evolving from, should we touch this at all, to, which form of exposure fits our mandate best? That is the kind of shift that changes markets quietly at first, then suddenly all at once. And that is the part retail investors consistently underestimate. They think adoption arrives with fireworks. It usually does not. It arrives through committees, filings, approvals, product design, and one credible institution giving the next credible institution enough cover to move. First, one firm does the hard, unpopular thing. Then another realizes it is no longer career suicide to explore it. Then another decides the reputational risk of ignoring it is starting to exceed the reputational risk of embracing it. That is how structural change happens. Not through hype alone, but through permission cascading across the system. That is the real meaning of conviction compounding. One institution moves. That move lowers the psychological barrier for the next. The next move lowers it again. And eventually, the asset that once looked fringe starts looking foundational. We saw versions of this with ETFs. We saw it with corporate treasury adoption. We saw it with custody infrastructure. And now we are seeing it in another layer of the stack. Regulated banks using Bitcoin-linked instruments as part of formal strategy. Each step does not just add demand, it adds legitimacy. And legitimacy is what transforms capital flows over time. Think about the sequence. First, Bitcoin had to survive dismissal. Then it had to survive hostility. Then it had to survive regulation. Then it had to prove institutions could hold it, custody it, trade it, and build products around it. Every stage removed one more excuse. Every stage made the next one easier. Now we are at a point where the old narrative is collapsing. The claim that Bitcoin is some isolated speculative toy for gamblers and internet diehards is becoming harder to defend with a straight face. Because gamblers do not build federally chartered banks around this ecosystem. Regulators do not oversee those entities. Institutions do not place balance sheet assets into instruments tied directly to that ecosystem unless something deeper is happening. And deeper is exactly the word for it. This is not surface-level adoption, this is integration. Bitcoin is being integrated into the logic of modern finance, sometimes directly through holdings, sometimes through ETFs, sometimes through derivatives, sometimes through preferred securities. But the direction is unmistakable. The ecosystem is getting thicker, the plumbing is improving, the set of available instruments is expanding. And every time that happens, another category of capital that once stood on the sidelines suddenly has a way in. That matters enormously for the future of the market because institutional capital behaves differently from tourist capital. Tourist capital arrives fast and leaves faster. It gets emotional, it panics, it chases. Institutional capital, especially when it enters through regulated structures, tends to be slower, more deliberate, and more persistent. It often comes with mandates, committees, reporting standards, and long-term objectives. That kind of capital can change the floor of a market even when it does not create instant euphoria at the top. It is less dramatic on social media, but much more powerful over time. This is why the most important takeaway from this story is not a quick price prediction. It is the recognition that the ownership base of Bitcoin-related exposure keeps maturing. When more of that ownership shifts toward regulated entities, structured products, and long-duration capital, the entire character of the market starts to change. Supply gets locked up differently. Volatility gets interpreted differently. Drawdowns get bought differently. The market becomes harder to understand if you are still using the old framework. Because the old framework assumed Bitcoin lived mostly outside the system. That assumption is aging badly. Now, none of this means risk disappears. It does not. A Bitcoin-linked preferred security is still connected to a company whose fortunes are deeply tied to Bitcoin. That creates concentration risk. If Bitcoin suffers a severe collapse, the pressure can ripple through the entire structure. Income instruments are not magic. Priority in the capital stack is not invincibility, and no institution, no matter how regulated, is immune to making a bad decision. But that is exactly what makes this move more meaningful, not less. Because professionals who understand those risks still decided the opportunity was worth taking. That should force a reset in how people think about the asset class. Not blind worship, not blind skepticism. A reset. Because the world has changed. We are no longer in the era where Bitcoin can be dismissed with lazy talking points from 2017. The market is becoming more sophisticated than that. The products are becoming more sophisticated than that. The participants are becoming more sophisticated than that. And if your mental model has not upgraded, you are going to keep misreading major signals as minor headlines. Here is the bigger truth underneath all of this. Finance is merging with digital asset infrastructure step by step, and most people only notice after the move is obvious. By the time the average observer finally says, "Wait, this is real now," the smart money has usually spent years laying the groundwork. That is why stories like this matter. They are not just news items. They are breadcrumbs. They tell you where the map is heading before the final destination is visible to everyone else. So what happened here is bigger than one bank buying one instrument. A federally chartered institution effectively signaled that Bitcoin-linked balance sheet exposure can fit inside a regulated financial framework. That is the headline beneath the headline. And once that idea becomes more normal, the next wave becomes easier to imagine. More institutions exploring similar structures, more banks offering related services, more treasury experimentation, more products designed to turn Bitcoin from a volatile outsider into a usable building block inside mainstream portfolios and payment architecture. The people waiting for some magical moment when adoption becomes undeniable may miss the real transition entirely. Because the transition is not going to arrive as one event. It is arriving as a chain reaction. ETF approvals, corporate treasury adoption, options markets, custody rails, stablecoin infrastructure, preferred securities, bank balance sheets. Every link strengthens the next one. Every move creates more precedent. Every precedent reduces friction. And reduced friction is how capital scales. So do not make the mistake of treating this like just another passing crypto story. It is a snapshot of institutional behavior under regulation. And regulated behavior tells you more than marketing ever will. It tells you where serious money is willing to stand once the noise is stripped away. Right now, serious money is not just talking about Bitcoin. It is learning how to hold it, structure around it, earn from it, and defend that position inside formal financial systems. That is the shift. That is what happened. And that is why it changes everything. Because once a federally chartered bank decides Bitcoin-linked exposure belongs on the balance sheet, the question is no longer whether the wall between crypto and traditional finance is cracking. The question is, how much of that wall is already gone? If you think this move is still too early to matter, that is exactly why it matters. The biggest transitions always look small before they look obvious. So here is the question. Are we watching the beginning of a new standard for institutional balance sheets? Or is this still just the first domino? And when the next bank moves, and then the next one after that, will the market realize what is happening in time? Watch closely. The price is only one part of the story now. And if you want more breakdowns like this, stay locked in and subscribe. The loudest headlines usually arrive last. The real opportunity is understanding the structural shift before everyone else can see it.